government should be providing initiatives and incentives to the private sector to develop longevity risk products.
What we've got is less than satisfactory. It's very complex, it's costly, continually being changed, and in the current circumstances the volatility is unacceptable to Australians who are retired or approaching retirement. That's an issue I've asked the Henry Tax Review to...
When Super Guarantee was introduced in the early 90s, we talked about the baby boomers one day retiring. It's off in the distant future. Well, the future's now, and they've only been accumulating their super since 1992. It's not too little too late, but we've got to be realistic. These are not going to be fully funded self-retirees.
I think the big gap in our market is that there's no product for people with a small amount of money who are risk averse and who want to address their longevity risk. That's the big gap in our market.
There's two key issues that we look at during the decumulation phase, or as members enter retirement and decumulate their savings. The first one is for those members who've gone through a financial crisis, as we've just seen, how do they recoup the money that they've lost? And was there actually something wrong with the governance model that enabled that loss to occur? And that's one thing that we're looking at really hard. And the second issue is for the funds who are looking at losing members, for example, to retail providers, is do they have the appropriate products in place to enable a seamless transition to retirement for those members?
Well, we do have an innovation. It was introduced almost 100 years ago, and that's the universal age pension.
I think one of the great tragedies that we have at the moment is about 80% of members, when they reach retirement, just take their money out of super and put it in the bank and start paying tax at full rate.
Keating did have the right system in place. You know, the 3% co-contribution and the 3% member contribution, taking the total cost to 15%. It was perfect. You know, why dismantle that? So now we've got a situation where everyone will be short on retirement, and then the other part of the question is, are Australian super funds doing enough for people approaching retirement? Now, there's advice issues here. People need advice, there's no doubt about that, but they also need quality, independent advice, something that people struggle to find at the moment.
I said to this guy, I want to take some money out for holiday. I've got this IWF trust fund, blah, blah, blah. And he had never seen my portfolio, and he said straight away, oh yeah, that'll be the best thing, that'll be the ideal thing. Now he doesn't know whether it is or not. He's only taken my word for it. So if that's the case, why am I paying them?
Last year's conference raised the issue that as our system starts to mature, or at least as adolescence comes into sight, that perhaps the decumulations phase needs more attention, that we need to recognise more explicitly that fund members in our system are the risk bearers, and that we need to take their total resources into account. So thinking about that mix of resources, there are a few things to take into account over and above their end superannuation balance, which is what we tend to focus on. Those resources include potentially their home, their human capital, and their claim on the age pension. And before anyone dismisses the age pension as a financial asset of diminishing importance, I can tell you that over the last 12 months, the reality is it's become much more important. And regardless of recent performance, the reality is that for 80% of the retired population, the age pension is their prime source of income. And in fact, the age pension is likely to be the prime source of income in retirement for between 90 and 95% of your default fund members. So when you're considering the asset allocation of your default fund, which we all spend a lot of time thinking and talking about, and if you're acting in the best interests of your fund members, it is appropriate to take into account the characteristics of the age pension. And I have to confess that I haven't really thought very much about that. And if you've thought about that, then I am very impressed. But the good news is that we have Justin, who's going to help us out. His presentation treats the age pension conceptually as another asset class and looks at its value, its risk characteristics and its correlations with other asset classes. We are very fortunate that Justin is not retired, but rather working on retirement system issues. He has a passion for understanding issues and finding solutions. So please join me in welcoming Justin.
The default fund for retirees, I think, is a pretty important topic. I think Senator Sherry said that about 80% or more than 80% of members don't exercise choice, and so they do go into the default fund. And maybe with the current crisis at the moment, when people are making some decisions, that number will come down. As Maria said, what I'm going to talk about is basically the design of the default fund for retirees, and specifically retirees, and I'm going to take into account the characteristics of the age pension. 65% of retirees rely on the age pension or government allowances as their primary source of income. For single retirees, that number is closer to 80%. For people who reach 75, that number is closer to 80%. So the vast majority of people in retirement are going to rely on the age pension, and the vast majority of people who don't exercise choice, who go into default funds, will actually rely on the age pension, the full or the part age pension. So it's pretty important to get it right. I'm going to actually challenge conventional wisdom a little bit. I'm going to say at the end of this that I think that retirees can take a little bit more risk than most people think that they can take in their retirement phase, the design of the default fund. And that seems to be a particularly silly thing to be saying right at the moment with the global financial crisis, because I think a lot of retirees at the moment have lost what little assets they've got, or a significant portion of the little assets that they've got. They're feeling very vulnerable, they're feeling very confused, they're probably a little bit angry, and the last thing they want to be told is that they can maybe take on a little bit extra risk. So I am conscious of the fact that I'm talking about the design of the default fund, the strategic mix, as opposed to the short run and working through the current situations right at the moment. I also need to say that I'm a fairly conservative, risk-averse kind of person. So although that's going to be my conclusion, I'll go through and take you why I say that as a conclusion, and we can look at the evidence. Okay, what I'm going to do is spend about 2/3 of the time going through 4 building blocks, talking a little bit about how funds organise the default fund mix at the moment, a little bit about theory, very, very little on that, the retiree's balance sheet, and then a fair bit of time understanding their age pension, and then put that together in the last third of the talk and say, what does this mean for the design of the default fund for people who will get the full age pension or the part age pension? So let's get underway. The first thing I did is I looked at the default fund that most large funds have, and I looked at the large funds and all the funds that have been nominated in industrial awards, and there were 21 funds there. Turns out that very, very few funds have a different default fund for pensioners than they do have for accumulation funds. So I looked at 21 funds. There were only 2 that basically had a separate fund for the retirees. And so the default fund mix is the same mix for members that are basically 20 as well as 75. For those few funds that did have a different mix as they got older, logic would tell you that they tend to have a much lower exposure to risky assets and growth assets, and that is borne out, and I'll show you on the next slide. And then there were some other interesting things. Across the 21 funds, there's actually quite a significant amount of variation. So a default fund is not exactly the same thing, and you can see there's some differences. Equity allocations, which typically are in the 50 to 60 bracket, can range from 31 to 68. Cash and fixed income, which is typically about 20, range from 5 to 45. And alternative asset allocations obviously can range quite significantly. Again, it averages about 20. The APRA average default fund mix looks like a 70-30 fund, or a little bit more aggressive than 70-30, and certainly over time we would expect this to come down a little bit. But you can see there that growth assets and risky assets are about 70-74%. For the funds that did have a separate structure for their older members, it is a much more conservative fund, and you can see there 55% in fixed income and cash, so it's a more conservative, which appears to be logical. Let me just go through theory and the way the way I think about this in terms of thinking about the design of the default fund. The idea of portfolio theory is that you should manage the risk and expected return across your entire set of resources. So we talked earlier, I think just after lunch, about the difference between DB and DC. In accumulation or defined contribution schemes, the member bears the risk on their superannuation just as they bear the risk on all their other assets. And so what the member is thinking about in retirement are what are all the resources I have and how can I manage those resources over my entire retirement. And so you've got to think about maximising across the entire set of resources. To do that, you need to estimate the value of all the assets and liabilities. So you've got to try and put a value on things. So one of the things I'm going to talk about is the age pension. The age pension at the moment for a single person is $14,615, the full age pension. For couples, I think it's $12,212. And that gets paid over your expected lifetime. And so we've got to put a value on that sort of expected cash flow over lifetime and come to some sort of value. And putting a value on all assets and liabilities actually turns out to be relatively simple. The next thing there is you have to estimate what is the riskiness of this asset? How does it co-vary with other assets? If I have this claim on the age pension, does that look like a portfolio of bonds? Or does that look like a balanced portfolio? Or is it cash, etc.? What does it exactly look like? And I'll spend a fair bit of time talking about the risk and the correlation with other assets. So putting that theory into practice, the idea is that the retiree thinks about their entire balance sheet. And if you look at a person in the accumulation phase, it's a much more complicated balance sheet because basically there you've got the income earning potential. So you've got your human capital, you're going to spend that to support yourself until retirement, you're going to save some of that, etc. So it starts to get a little bit more complicated. But if you take the typical retiree and you say that the retiree has stopped working, they will have a present value claim on the age pension, and that is the sort of the current value of this claim that they'll get over their expected life. They may have some financial assets, and those will be inside superannuation or maybe are in their own hands outside in super, and I'm going to lump those two things together. And they will have some property assets. And then they think about those resources and they think about how do I allocate those resources to spending on a year-by-year basis until my expected age of death. Now, the big problem for people is that they don't know when they're going to die. And so some people are going to retire at 65 and maybe be dead at 68, and others are going to retire at 65 and still be alive at 100. And so they've got to have some planned spending schedule. I'm going to calculate the present value of the planned spending until the expected age of death. And I'm going to take as the representative investor a single retiree woman who retires at 65. And a woman at the moment who retires at 65 on average can expect to live another 21.6 years, so approximately till 87. A lot of people basically, if they have a wine cellar, they want to drink their last wine the day before they die. If they have any money, they want to spend their last dollar the day before they die. Unfortunately, we don't know when we're going to die. And so what we've got to do if we've got some private assets is basically allocate those over a period of time that we're not certain how long that time is going to be. So a lot of people leave an estate even if they don't intend to leave an estate. So let me really go on to the kernel of this, which is understanding the age pension. And to understand the age pension and put a value on it, you need to think about what is the amount that you get out each fortnight, how does it grow over time. You need to think about how long is it paid for. It's basically a wonderful asset. It's a life annuity, and it is paid for life. Your life expectancy decreases as you get older, but it also changes over time as we get better estimates as to how long people are going to live. And these are average life expectancies, so the individual can have quite a different life expectancy depending on their family circumstances. To put a value on the stream of cash flows, we're going to have to discount it at some discount rate, and this is an asset provided to you by the government, so I'm going to discount at government bond yields. And you've also always got to be aware of policy changes and rules, and various things can happen. And maybe in the question time we can talk about some of those rules, because as you know, at the moment there's been the Henry Tax Review, and it's looked at retirement incomes, and there's a lot of things up for grab potentially in terms of the age pension. Let me show you how you might value the age pension as at December 2008 for, as I say, a 65-year-old female who retired just at December 2008. The current single pension, if you're getting the full age pension, is $14,615. A female who retires at 65, on average, can expect to live until close to 87 for the next 21.6 years. And so we're going to take that $14,615, growing at some rate and discounting it back to a present value right at the moment. The discount rate we're going to use is the Treasury bond yield, which was about 4.1% at the end of 2008. So that's the discount rate that we're going to use. And the age pension tends to grow with inflation, and it's also linked to average weekly ordinary time earnings. And so if there's real wage increases, the age pension will go up. So we make some estimates as to the expected rate of inflation. And the expected rate of inflation there I've got is the difference between the nominal yield on government bonds, long-term government bonds, and the real yield on capital index bonds, long-term real government bonds. And the expected inflation at the end of 2008 from government bonds was about 1.6%. And on average, I'm going to assume that real wages go up at 1%. You put all those together in a discounted cash flow technique and you get $263,000 is the value of the age pension to someone who has just retired and gets a full age pension. Now let me just go forward 2 months just to show you how this can change over time. 2 months later, the pension is exactly the same. Obviously, you've got 4 fortnightly payments before the end of February, but the actual level of pension is exactly the same. Life expectancy has decreased very, very marginally because you're 2 months older and you've got a little bit less long to live. Treasury bond yields have gone from 4.1 to 4.6, so the discount rate has changed. The real rate in the economy at the end of December 2008 was 2.5. By February, it had fallen to 2.2. And so the real rate had fallen, which makes a lot of assets more valuable. And the implied inflation had jumped from 1.6 to 2.4 for a variety of reasons. Maybe it was the stimulus package and people think down the line there's going to be inflation. But you can see all these variables change. If you again put in the 1% real wage growth, the value of the age pension 2 months later would be $268,000, $5,000 more valuable, and as I say, you've got 2 months of age pension. So your asset, the age pension, has gone up almost 3% in that 2 months. Australian equities fell 9.2% in that same 2 months. So you can see now, if you're taking a total concept, your age pension asset has gone up, your other asset, Australian equities, has gone down 9.9%, and we can start to see the dynamics. I went back and I valued the age pension month by month, quarter by quarter for the last 12 years. So if you go back to 1996, the age pension was a little over 9,000, and by 2008 it had grown to 14,615. And you can see there the growth due to inflation is the green, and the growth to real wage increase is actually the orange. The pension grew at 4.12% per annum for that 12 years, which was about 1.4% faster than inflation. And so the age pension grew 62%. About 2/3 of that came from inflation, and about 1/3 came from real wage increases. Pensioners are, on average, in real terms, 17% better off 12 years later than they were in 1996. And you can see year by year, the green lines there along the bottom of the years, 97, 98, etc. The green bars are the rate of inflation. The grey bars are the increase in the age pension. And you can see that on average, the age pension goes up by the rate of inflation plus a little, sometimes plus a lot. Life expectancy when the person retired was just under 20 years, and now they would be 77. It would be something like about 11 years. Life expectancy tables have been revised, and they're slightly higher. Now the 77-year-old can expect to live another 12 years. And so we've taken into account changes in life expectancy. As I say, the bond yields have fluctuated from about 8% down to about 4%. The real yields have been falling, and that's one of the things that pushed up asset prices in the boom 2003 to 2007. You can see implied inflation was starting to rise prior to 2007, 2008, and people were starting to say we need to curb back inflation. But now with the crisis, inflation has fallen off, and we're more worried about deflation. And the last sort of component is who gets the full age pension. And there's an income test and there's an asset test. I'm just going to do the asset test. For a single person, if you had less than $124,000 in other assets, you would have got the full age pension in 1996. That number now is $171,750. And so the amount that you can have outside super and still get the full age pension has gone up. The yellow is the amount that you can have and still get access to the part age pension. And you can see that there was a taper rule that used to apply for most of this time. In September 2007, the government became twice as generous as it used to be. So now you can have $546,000 in assets and start to get a part age pension. And so those are all the building blocks to value the age pension. I should note that in this sort of inquiry, those are some of the things that people have started to sort of discuss as to whether we should change. So I know Rice Warner has basically said, is there a logic for raising the minimum threshold to a higher number and taking out the taper entirely? So you spend your own money, and then once you've spent your own money, then you go into the full age pension. And we can talk about some of those things maybe at the end. What's been the performance of the age pension? Well, if you retired in 1996, the age pension was worth $126,000. It's a little bit out of line there, but you can see at the bottom, if you were still alive at 77, the age pension would now be worth $156,000. So you've lived for 12 years, and it's now worth more. That's because pension levels have gone up, real discount rates have come down, and also inflation has occurred, so that we're not talking the same sort of dollars. So in real terms it's fallen, but in nominal terms it's gone up. You can see there that the actual return for 12 years for all retirees is 8.8%. That's the return for people who have remained alive for the full period of time and the people who have died at 66, 67, 68. The return for people who are alive is actually 10.1%. And these slides will be distributed at the end of the conference, I'm sure. You can see there that the real return after fees and taxes has been 7.2%. So if you think about your funds and you think about the balanced fund, the default options, the growth options, etc., and the target rates of return, 7.2% after fees and taxes is a wonderful asset. Many of us would substitute all the money we've got to get this kind of return. The green line shows you the performance of the age pension as an asset versus Australian bonds. You can see it pretty much has the risk of Australian bonds, but it's outperformed. The blue line there is international equities. Initially, it looked like international equities were going to completely dominate the age pension. They rose dramatically in the late 90s, but as we all know, they fell away at the turn of the century. They rose a little bit again, and they've fallen. You can see Australian equities looked like they were going to dominate the age pension, but they've also fallen away. So it's a little bit like the tortoise and the hare. The age pension has proved to be a wonderful asset. Those are the risk characteristics, as I say, taking the age pension and valuing it each month or each quarter, and then taking all these other assets and comparing it. Essentially, it's got the risk of a portfolio of bonds. The risk of a bond portfolio is about 3.9% over this period. Inflation-linked bonds about 3.7%. So it's a little bit risky than a single sort of bond portfolio. You can see it is positively correlated. It moves in the same direction as cash, Australian inflation-linked bonds, and Australian bonds. And you can see that it's sort of low correlation, sort of uncorrelated with growth assets, and potentially even slightly negatively correlated. Okay, so it's a wonderful asset. It's an asset that is paid for life. It's an asset that typically, as I said, over the period from December to February, went up 3%, while Australian equities went down 9%, and it's got those correlations. So now I want to sort of get on and say, let's put all this together, think about the asset mix, and then I'll open it up for questions. If we look at the retiree balance sheet, just to give us a sort of a starting point, the age pension is worth $263,000. Let's assume someone didn't have any private assets. They only had the $263,000, but they had their own home. If you look at the wealth studies, the average retiree that is single over 65, something like 77% of those people own their own home. And the average value of the own home is $299,000. So the value of the age home there would be a typical single retiree. How would they spend those assets and what sort of a state? So I'm going to assume that they get the age pension in and they spend it each month. They live in their home and they maintain their home, so in real terms it's worth the same amount when they at their expected age of death at 87, and so their estate would be $300. Now obviously their spending could be slightly higher if they sold their own home and they downsized, if they got a reverse mortgage or whatever, but you have to make some of these assumptions. So the income in retirement, and I put it there as a percentage of median wage is. So the age pension is about 25% of average weekly ordinary time earnings. The median wage is about 75% of average weekly ordinary time earnings. And so on its own, the age pension will provide about 33% of the median wage and will be paid for as long as someone lives. Okay, so the interesting thing is, if we have members in our funds and they have an amount of money inside the fund for super, and the amount of money is less than $171,000, they will have access to the full age pension. So that number in super could be anywhere from 0 up to about $172,000, and I've assumed 170 there. And the issue is they have the full claim on the age pension, 263,000. They have their private savings of 170. They have the home of 300. How should they spend it? And it's a little bit out of a line there. What are they going to have at the expected age of death of 87? And how should we invest it? Let me give you a couple of spending patterns. One pattern might be to say, I've got 170, I expect to live another 22 years. Let me spend that entire amount over my expected life. If I live to my expected life, I'll spend at about 55, 56% of median wages until I'm 87, and then I'll live off 33% of median wages. In other words, you spend your entire amount over your expected life. If you live less, you leave an estate. If you live more, you actually cut down your standard of living. The second thing you might do is basically keep revising how long you're going to live. So at 65, you say, I'll spend it over the next 22 years. But if you're still alive at 70, you don't reduce it by 5 years. You actually go to your life expectancy at 70. If you do that, you taper your spending, and you will still have some assets at 87, and you can see that your income falls away. Now, your income there falls away from about 55% to about 46%. And one of the things I've done in these graphs is assume that you invest in risk-free assets. So this is basically just smoothing your money but not taking any investment risk. Why do people take investment risk? Because on average, if you take investment risk, you can expect to get a higher rate of return, but you obviously get some volatility. If you can take the extra risk and cope with that volatility, if your tolerance is good enough, you can keep that line flat. And that's why people in retirement should take extra risk. Okay, so that's the trade-off. You can take no risk and your income will fall away. You can take risk and you can expect to keep it flat, but there's some uncertainty. And so you can make this change. And the last way of spending is to spend at the government's minimum required rate, 5% from 65 to 74, 6% beyond that, etc. And that's the one I've assumed. So if you do this, essentially that 170, at age 87, you will have spent 95 of it and you'll have 75 left. And so if you die at your age 87, you will have your home plus still 75,000, and your spending would have been higher. It will be the age pension plus the other 95 spread over that particular period of time. The question is, how should we invest that 170? If we take the perspective that we're only focused on the super, the amount of money with us, we're looking at someone who's over 65, we're looking at their entire sort of pool of 170, and we know it's not a big pool, and we know they've stopped working, and we know they're relatively vulnerable. So we would be fairly cautious as to how we invest it. If we look at a bigger perspective, taking the age pension into account, we're looking at a bigger pool of money. We've got 433,000. We've got the 170 we manage and the other 263, which is the age pension. If we were to manage that full 430, we'd probably take a significant part of it and put it into less risky assets. But the government has already done that for us. It's taken 263,000 and put into a portfolio of bonds and inflation-linked bonds, etc., bonds and cash. And so we know that a big part of the portfolio is already very safely invested, and it's uncorrelated with risky assets. So the bottom line there is that we're managing in default funds money for retirees, where more than 60% of the resources is already in an income-producing inflation-linked life annuity, a very low-risk set of assets. We also know that this asset is uncorrelated with risky assets. So if we go through a global financial crisis and other assets fall, the value or the claim on the age pension won't fall. And we know that even if we invest 70% of the assets we manage, their total portfolio, it would be just 70% of about 40%. There's still only 30% invested in risky assets. As I say, the reason to invest in risky assets is that they offer a higher return, and if you can get that higher return, if you can bear that risk over time, you will have a much higher standard of living throughout retirement. And so the bottom line there is a typical accumulation mix makes sense in a total portfolio sense. I'm very nearly at the end, and I know I've spoken quite quickly. What I'm going to do just briefly is go through the part age pension, because it's the same principle, but actually with a slight twist. What happens if the people in your default fund have more than enough assets to basically get the full age pension? In other words, they're going to get the part age pension. So let's assume you've got someone who's basically got 400 in super. They've got a slightly more valuable home, 400. And the question is, what age pension do they get? What's the value of the age pension? And how should they do their spending and how should you invest it. Now, if you have 400,000, you'd get 39% of the age pension. You'd get about 5,700 a year. But the value of the age pension is not 39% of the 263, because over time, what happens is that people use their own money, and over time, their own assets go down and they get more of the age pension. So on the graph down there, you can see that the bottom sort of blue is your claim on the age pension. The present value of the age pension starts at being 39% of the age pension and goes up until at about 84, you're getting the full age pension. And the spending above the blue is funded from your own super. And so what you're doing is you're trying to work out a spending policy and therefore the value of the age pension. Turns out, using a particular spending policy that I've got there, the value of the age pension is about 200,000, super is about 400, the home is about 400, so you've nearly got $1 million in assets. And if you were to spend at that rate that I suggested there, of the 400, you'd have spent 265, and you'd still have 135 left. So your estate at the end, if you don't sell your house, is your home worth 400 plus the 135 in your savings that you've still got. So let's look at September 2008 and what happened over the last quarter. You've got 400,000 in super, you're getting a little bit of the part pension, 5,000 a year, and the value of the age pension is 199. December quarter was a bad quarter, obviously, as everyone knows, for super. Chant West says on average, funds of this characterization, about 60-70% in growth assets, lost nearly 11%. The super would have fallen from 400 down 11% to 356. You would have lost 43,000. At 356, your claim on the age pension goes up. Instead of getting 39% of the age pension, you now get 7,414. Your claim on the age pension has gone up 30%. The value of the age pension has risen from 199 to 214. It's gone up 15,000. And so you can see that what happens for people with the part age pension is that as their assets go down, their claim on the age pension goes up. So not only is the age pension a great portfolio asset, but the part age pension has this negative correlation. So the bottom line there is for retirees with a part age pension, the change in the age pension is negatively correlated. And in portfolio sense, negative correlation is a wonderful thing. It allows you to take on greater risk because it gives you a much greater tolerance of bearing risk. I won't go through the next slides too much, but you can see that the logic remains the same, but the numbers change. So if you had 300,000 in super, you would have a greater age pension and the value of the age pension would be higher. A fall of 11% is not as big a dollar fall as before, but the rise in the age pension is not as big a dollar rise as before, but the same negative correlation works. So if you've got more than enough assets to get the full age pension, you're getting this offsetting effect. I've tried to show this in a graph which says on the bottom line, if you have 100,000, 200,000, 300,000 in private assets, your value of your age pension is in green. If you're to lose 10% of your own assets, how would the value of the age pension change? And you can see the blue lines are all slightly higher, and they're more higher depending upon you having a greater amount of assets. So if you have 100,000, you're going to get the full age pension. If your assets fall, you're still going to get the full age pension. You haven't got that negative correlation. But once you've got a reasonable amount of assets, you do get it. And that's the sort of the increase in the value of the assets depending upon how much assets that you have. So the implications are retirees that have a claim on the part age pension have less of their total resources in this wonderful asset. But the wonderful asset has an even greater attribute. It basically is strongly negatively correlated with returns to all risky assets. So this is not just risky assets that offer market risk. It's risky assets that offer active risk. It's also negatively correlated, to problems like inflation and it's, to spending, etc. It's really got a wonderful characteristic. And so again, the amount of money we manage for people who have claim on the part age pension can take a little bit more risk because of this wonderful characteristic. So the conclusions, I guess, is that retirees are concerned with their total retirement income throughout retirement. I know that they focus on the balance and I know that they're very worried about risk, but ultimately, what can they spend over their entire life and they don't know how long they're going to live? Taking into account the age pension basically says it's got some wonderful characteristics which gives them the ability to bear risk, and if you take on risk on average, in the long run, you'll get a higher rate of return which gives you a higher retirement income. And so the bottom line there is that default mixes don't appear unreasonable. Now you can be a lot more sophisticated. You can put the correlations into an optimizer and get out default mix, etc. And that may be sort of false precision. You can model a lot of the uncertainties facing retirees, so you can show them if you go into slightly more risky assets, how their income over time will change, etc. And so you can use this kind of analysis to get a lot more sophisticated. But the bottom line is, for most people in the default funds, they will have a claim on the full or part age pension. Those characteristics should be taken into account, and they have wonderful characteristics that allow people to take on a little bit more risk, properly explained to them. Thank you.
I'm interested in the negative correlation, and we found out yesterday that correlations increase when at times of crisis. So, a lot of people have felt that they've had diversified portfolios, and that's not proven to be the case over the last 18 months or so. So the age pension has these negative correlations. But my question to you, Justin, is can we rely on those characteristics persisting through this time of crisis? Another way of asking that question is the government going to fiddle with it?
Yeah, and I think that's a very, very, very pertinent and good question, because essentially when you build the design of a structure, you've got to take into account what you think are the risks of the different components. And one of the risks of the age pension, as you rightly point out, is that the rules may change. And so is it likely that the age pension rules would become less generous when there is a major downturn in all other assets? Well, if there's a major downturn in all other assets, tax revenues are going to fall, etc. People are going to become less able to pay these things. And so that definitely is a risk. And a number of things have happened around the world. So in Europe, when pensions became too expensive, they stopped giving people basically wage level increases. They just gave them inflation increases. To take off the real wage increase would take off a significant amount of the benefit of the age pension, which would severely hurt people who were relying upon that in this particular way.
The Jack Gray's Centre for Capital Market Dysfunctionality, that was, I think that was terrific, I thought, Justin, to have all that put to us. A couple of questions. One, what's the duration of the age pension, so to compare it to an equivalent sort of bond? And secondly, you said something about how long we live. We all both want to know when we'll die and not want to know when we'll die. And we've got data, say at 65, you say that the data is 21, 22 years. How much better an estimate can you get when you go into the cohort and say, look at the family background, at the sort of work the person's done and so on and so forth? Can you actually get much better estimates of life expectancy from that?
Yeah, so the duration, how sensitive is it to interest rate changes? Being an inflation-protected asset, the most sensitive variable that goes in there is the real rate. And so when real rates go down, and if you go back to my graph, you can see that in Australia, real rates have fallen from about 5 down to about 2.2, and that's been pretty valuable for all assets, including the age pension. And it's a long-dated thing. I mean, obviously, the duration for the age pension for an 80-year-old is going to be shorter than for a 65-year-old. So it's a relatively long duration, so it would be relatively sensitive to real interest rates is the key question. In terms of life expectancy, I don't know, one of the actuaries might be better placed, but clearly I've heard it said that you can become better at predicting life expectancies when you do take into account family circumstances and those sort of things. The truth of the matter is that even with family circumstances, most individuals are very uncertain as to how long they're going to live. And that's been a lot of the talk as to why we need annuities and longevity bonds, etc. What this says is, in fact, the government does issue annuities and longevity bonds to a large extent, and they issue it to a significant portion of the population already. They don't just give it to super funds who can then create the products. They give it directly to the retirees. But ultimately, it is part of the retirement system and the retirement package.
Hi Justin, Lorraine Behrens from Marvin and Palmer. My question's a little bit, it's related to your topic, but maybe an extension. Had you looked at all about self-funded retirees? And I know you're then moving away from the attributes of the age pension, but I'm just interested to know, again, if we're talking about asset mixes, not just default fund, but generally for self-funded retirees and the circumstances in their case.
Yeah, so I mean, someone who retired and individually, let's say, had $1 million plus their own home, they probably, unless circumstances are pretty bad, won't get the age pension at all. So the value of the age pension would be a zero asset. It wouldn't be taken into consideration. If they lost 30% of that, that same person would be at 700, and all of a sudden they'd start to think, I could actually get the age pension. They may not get any immediate claim on the age pension, but by the time they're 5 years older, having spent down what they've got, they will. So the bottom line is that people who've got a lot more money, maybe self-funded retirees, they don't get the age pension, so therefore they may need some kind of longevity insurance, but they also have enough assets to actually leave an estate anyway. So because they can leave an estate, they don't need those sort of things. So it's a different problem for those different people. And obviously take into account the future value on the age pension and human capital. You can do the same thing for accumulated members in the accumulation phase in default funds.
My name is Ramani. I am from APRA. Two questions bar comments. In arriving at the mathematical conclusion which you have arrived at, it seems suitable. What kind of allowance have you made for the liquidity needs of people who might be in retirement as opposed to people who might be in accumulation, ignoring for a moment portability even during accumulation? And the second thing is, what kind of allowance have you made for the fact that during the withdrawal phase, I don't like the word decumulation, you have made, what kind of allowance have you made for the fact that it's a tax-free accumulation?
The first one, basically on liquidity, maybe there's two answers to that. One is that in terms of risk and return, what I'm saying is that if you have 433,000 in assets, and you put 60% of those into a portfolio of bonds and cash, which is what the age pension is, you can take more risk on this other part here. But as you point out, this, although it's got the same value as 263,000, is not 263,000, so if you need 50,000, you can take it out. And so liquidity would say that the remaining part, the 170, you wouldn't put it 100% into risky assets. You would maybe put 70% into growth assets or something, so you would still look after liquidity needs. So liquidity is another sort of factor that you've got to take into account into how you design the default fund. So that's why I think you'd always have some cash in default funds, and some of those default funds for retirees had a reasonable amount of cash, and you'd look after that. The fact that it is sort of tax-free, I think, the idea is really you're trying to look at the risk and return characteristics after fees and taxes. If something becomes tax-free, then the expected numbers that you put in are a little bit higher, but I don't think it really changes the analysis much, unless I've missed the point.
Howard Rosario from West Scheme. It's just following on the previous question from Ramani. In most of the funds that you've looked at, we've taken comfort from the fact that you say that the current allocation at about 70% of growth assets is probably right. But do you have a view then, or did your work look at unlisted assets within this portfolio as the growth component? Are you willing to venture a view that perhaps they should or should not be in such a portfolio?
Well, again, maybe there's two answers. I know APRA have said that one of the concerns with unlisted assets and liquidity is that as the population ages, and the assumption is on average people get more conservative, we're going to have a lot of people go from growth funds in the accumulation to be more conservative as they retire, and that is going to put strains on some funds who've got large amounts of unlisted assets. This analysis says that when you look at the entire portfolio, you take into account that retirees, they haven't got a claim on human capital, their income, but they got a claim on the age pension. They can still have a reasonable amount of risky assets. Maybe that drawdown from growth assets in the retirement phase is not as great. So that would actually help liquidity. In terms of whether you should actually invest in unlisted assets or less listed liquid assets, it's a little bit Romani's point there. You need to have some money to make sure that you can meet your liquidity needs. But on average, what people are looking for is a yield. So if you retire at 65, what you really want for the vast majority of your assets is something that will pay you an income when you're 65, 66, 67, 68 along the way. You may need some money that you can sell, but we shouldn't be as focused on the number of the value of this asset. We should be looking at the yield and what we can do with it. Obviously, the number gives us some cue as to whether, in fact, this is a good asset or not, so we look at it that way.
Ian Silk, Justin.
Yeah.
Fantastic presentation. A question in the context of the Harmer Review and the Henry Review and this holistic approach to retirement incomes, what are the 2 or 3 most important public policy initiatives you'd like to see the government do in those reviews report?
One of the things that I feel very strongly about, I guess, is that when we look at the age pension, a lot of times people basically say we need to fiddle with it and change it because it's going to become less affordable. And so they're looking at the payments that come out of the age pension, the benefits that are paid. And at the moment, I think it costs something like 3% of GDP, and it's predicted as we get older to go to 4.7%. I actually think that what we need to look at is the total cost of the superannuation and age pension system. And so we need to take into account the total cost of the tax incentives and the benefit payments that we get, and think about managing that total cost. And it's important to do that because if we only focus on the benefits, certain people get the benefits, and if we try and cut those down, that's going to hurt them, and other people get the tax breaks and tax incentives. So to put the 2 things together, think about what's that total number, and then who gets it and how much we can afford. That gives us a bit of perspective. I think the other thing is that we really want to try it's a safety net for those people who haven't got sufficient other assets. But it's also a portfolio of assets for the average middle class, for the average sort of person. And so I think that, thinking about the implications as to how you get into the age pension, the taper rules and things like that, the other assets, whether you include sort of your own home in the other assets or some portion of your own home, those are important things because it is both sort of the adequacy and the cost of it that we've got to look at. I don't know if I really answered, but...
Yes, Gerard Noonan from Media Super. There was an earlier question in relation to the impact of changes on the pension, in other words, the government fiddling with the pension rate. But doesn't the logic of your calculation mean that you're raising questions about the adequacy of super? In other words, isn't that, if I read or listened to your presentation correctly, isn't there a sweet spot at about $170,000 that you would sensibly maintain super, but then until you got to somewhere close to $700,000, there's really no purpose in finding yourself in that. I suppose it's the opposite to a sweet spot. And so that the question about how adequacy should work for the superannuation system is raised by your calculus.
I think that people who have insufficient assets or people who have assets that allow them to get the full age pension, they probably haven't got an adequate income in retirement. And so one of the comments made earlier at the beginning, or maybe on the screen at the beginning, is that the system hasn't yet matured. And the idea of the system is that once it is matured, the age pension plus your own savings will give people maybe 60, 65% of pre-retirement incomes. And I've used median incomes there. And so with 170,000 in assets, you do get the age pension, which gives you 33% of the median wages. But the other one only adds another about sort of 20, and it goes down over time. The sweet spot to me is recognizing that, in fact, people who go beyond that, they do dig into their own assets first, but they have this safety net and this wonderful asset that if things go badly too quickly, this other one goes up. So, I think that the consideration of people who are in the system, and as we mature, more and more will be in that group, who have assets between 170 and about 600 if they're single age pensioner. That's, the ones that we need to think about to a large extent, and not only the ones that are, that get the full age pension.
Winston Hughes from Spec Queensland. Thanks, Justin. There's a question I've got on the default funds. When people are in retirement, they face the dilemma of cashing out a default fund, say 30/70. Isn't there an argument that the retiree should actually be partitioning their investment so they've actually can have short-term investment which can immunise cash flow, say, for 2 or 3 years, and then remain the balance of it in growth funds so they can actually suffer less dissonance when they actually do have to cash it out? And secondly, taking Ramani's question again, in the framework of that growth fund, or that portion of the assets for the retiree in the growth fund, the fact that Australian franking credits have great advantage over other assets offshore, isn't there an argument that retirement funding for retirees in fact should have completely different portfolio construct, taking advantages of those characteristics?
Okay, the first one again on the liquidity, I think that the desire to have an amount of money which you can access for special needs, or the amount of money that will fund your spending over 2, 3, 4 years without having to sell your assets, that comes from both owning defensive assets like cash and that sort of thing, and it also is the income stream you get from the other assets. So the thing that you don't want to do is you don't want to have to sell things when you don't want to be a forced seller. And so if you had a 70-30 balanced portfolio, 70% in growth assets and 30% in defensive, and you took the income and the franking credits from this, that would cover most people's sort of liquidity needs. The second thing about the value of the franking credits, they are valuable to people who are tax exempt. Whether that remains completely forever is also, one of the questions. So there has been some discussion as to whether the Henry Tax Review would look at dividend imputation. In 1997, the UK government had a tax credit system, and they stopped paying tax credits to tax exempts because the system was becoming too costly. So, all of those things need to be taken into account. If you skew too much towards these things which pay a lot of these tax credits, and that rule were to be changed, the value of those assets would fall, and you would suffer some loss on that, as well as the income loss, the price lost.
But please join with me in thanking Justin.